ServiceNow is actually worth 250 to 300 per share. Now, let's have a look at the business model. ServiceNow is a cloud-based software company that helps organizations digitize, automate, and optimize workflows across the enterprise. Its platform connects departments such as IT, HR, customer service, security, and operations through a single data model. The core of the business is the Now platform, which provides workflow automation, AI-powered assistance, integrations, analytics, and security capabilities. This allows organizations to streamline processes and improve efficiency across multiple functions. ServiceNow creates value by reducing operational costs, improving employee and customer experiences, strengthening compliance, and accelerating digital transformation. Its customers include large enterprises, government organizations, and many Fortune 500 companies worldwide. The company generates revenue through recurring subscriptions and follows a land and expand strategy. Customers often start with one module and later adopt additional solutions. This creates predictable recurring revenue, strong customer retention, and long-term growth driven by AI innovation and workflow automation. Now let's take a look at the fundamentals, financial health, and performance. ServiceNow's revenue has grown consistently from approximately $7.2 billion in 2022 to nearly $14 billion TTM, driven by customer expansion, recurring subscriptions, and increasing demand for workflow automation and AI solutions. Net profit declined in 2024 due to acquisition-related costs, AI investments, and delayed enterprise spending. However, earnings have since recovered strongly, demonstrating management's ability to invest for future growth while maintaining long-term profitability. ServiceNow's cash flow has shown a strong and consistent uptrend over the past 5 years. Operating cash flow grew from $2.7 billion in 2022 to over $5.4 billion TTM, while free cash flow increased from $2.2 billion to $4.6 billion. This reflects strong cash generation and operational efficiency. ServiceNow's accounts receivable has increased in line with revenue growth, rising from $1.7 billion in 2022 to $2.6 billion in 2025. This suggests that revenue growth is supported by real customer demand, while collections remain healthy and consistent over time. Now let's take a look at the fundamentals. Financial ratios. ServiceNow's ROE of 15.39% exceeds the benchmark range of 12 to 15%, indicating strong returns on shareholder capital. Its debt-to-EBITDA ratio of 0.75 is well below the threshold of 3, reflecting low leverage and manageable debt. However, ROIC of 6.48% remains below the preferred range, suggesting room for improvement in capital efficiency. The current ratio of 0.84 is below 1, indicating tighter short-term liquidity. Now let's take a look at the market share. ServiceNow is the clear leader in the IT service management market, holding approximately 44.4% market share, significantly ahead of competitors such as Atlassian at 15% and BMC Software at 10%. This leadership position reflects the company's strong brand recognition, extensive customer base, and comprehensive workflow platform. Its dominant market share also reinforces competitive advantages through higher switching costs, ecosystem strength, and greater opportunities for customer expansion. So the big question is, who are the clients of ServiceNow? ServiceNow serves many of the world's largest organizations, including Accenture, Deloitte, Walmart, Apple, Amazon, Goldman Sachs, Delta Airlines, and NASA. These customers rely on the platform to automate critical workflows across IT, HR, customer service, security, and operations. The fact that 85 to 90% of Fortune 500 companies use ServiceNow highlights its strong market position, customer trust, and importance in enterprise operations. So, what is the moat of ServiceNow? ServiceNow possesses strong brand monopolies, being the global leader in IT service management with approximately 44% market share. Its platform is trusted by many of the world's largest enterprises, making it one of the most recognized and widely adopted workflow automation providers. ServiceNow benefits from economies of scale through its large customer base and unified platform across IT, HR, security, customer workflows, and AI automation. This allows the company to expand efficiently while generating recurring revenue. Customers integrate ServiceNow deeply into daily operations, making switching costly and disruptive. In addition, a growing ecosystem of partners, developers, and integrations increases platform value and strengthens customer retention. High barriers to entry further strengthen ServiceNow's moat. New competitors require significant investments in technology, enterprise sales, and customer trust. Combined with its AI capabilities and market leadership, these advantages support long-term growth and profitability. So, what is the intrinsic value of ServiceNow? To estimate ServiceNow's fair value, I used a discounted cash flow or DCF model. This approach values the company based on its future cash flows and determines what those cash flows are worth in today's dollars. Based on the assumptions used, ServiceNow's estimated intrinsic value is $253.71 per share. This reflects the company's strong revenue growth, expanding cash generation, and long-term opportunities in workflow automation and AI. Compared to the current share price of approximately $128.81, ServiceNow appears to be trading below its estimated intrinsic value. This suggests that the market may not be fully pricing in the company's future growth potential. A discount of 96.96% if ServiceNow continues to execute successfully. However, DCF valuations are highly sensitive to assumptions, so investors should view as an estimate only. Overall, ServiceNow's strong market leadership, recurring revenue model, growing cash flows, and a high-driven growth opportunities support a higher intrinsic value and reinforce its long-term investment attractiveness. Now, we will be doing a comparisons with competitors to choose the best. ServiceNow generated approximately $14 billion in revenue and $1.8 billion in net income, demonstrating its ability to scale while remaining profitable. Compared to Atlassian, which reported a net loss, ServiceNow maintains a stronger earnings profile. ServiceNow's ROE of 15.39% exceeds both Atlassian and BMC, indicating superior returns on shareholder capital. This highlights management's ability to grow the business while creating value for investors. The company also maintains a debt-to-EBITDA ratio of 0.75, reflecting low leverage and a healthy balance sheet. This provides flexibility to invest in AI, acquisitions, and future expansion opportunities. Overall, ServiceNow combines strong profitability, capital efficiency, and financial stability, positioning it favorably against competitors and supporting its long-term growth outlook. Now, you're thinking, what about the stock performance of them? Over the past year, ServiceNow's share price declined approximately 39% due to AI concerns on software as a service and broader software sector weakness. Over the past 5 years, ServiceNow delivered approximately 30% returns, outperforming Atlassian, maintaining strong revenue growth and cash generation. Since its IPO, ServiceNow has generated returns of approximately 2,500%, significantly outperforming many peers. Driven by consistent revenue growth, strong cash generation, and its dominant position in the sector. Now, you'd be thinking again, when do we buy the stocks? From a technical perspective, ServiceNow is currently trading near a key resistance level around 124. A successful breakout above this level could signal renewed bullish momentum and open the path toward higher price targets. On the downside, major support levels are located at approximately 90, 67, and 48, which may provide areas of buying interest during market pullbacks. Most importantly, we got to look at recent acquisitions as well to know what is the direction of company. ServiceNow's recent acquisition strategy is focused on strengthening its AI, data, and automation capabilities. Through acquisitions such as Normalize, DataWorld, Data Domain, and Engine AI, the company is building a unified data foundation, industry-specific intelligence, and advanced AI-driven automation. These investments support ServiceNow's vision of becoming the central operating system for enterprise workflows and accelerating long-term AI adoption across its platform. So, what is the future catalyst and risks of ServiceNow? ServiceNow's growth is supported by several key catalysts. including increasing adoption of AI-powered workflows, expansion across cloud and enterprise solutions, strategic acquisitions, and a large addressable market. Combined with strong recurring revenue and high customer retention, these factors position the company for continued long-term growth. While some key risks include macroeconomic uncertainty, intense competition from major software providers, cybersecurity and data privacy concerns, as well as integration risks from acquisitions, rising operating costs and evolving regulations could also pressure margins and impact future growth. In conclusion, ServiceNow combines strong fundamentals, a wide economic moat, growing AI capabilities, and an attractive valuation. These factors position the company as a compelling long-term investment opportunity. Follow and subscribe for more investing insights. Thank you and have a nice day.